Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder and this is BRN AM for Wednesday, September 9th, 2020. And our top stories today, we'll take a deeper look at what the private markets are and then discuss how they may fit into your retirement plan. Joining me now to discuss this and more is Hayden Gallery. He's a managing director with Cambridge Associates, and Tom Keck, who's a partner with the Stepstone Group. Gentlemen, thanks so much for joining us on the program this morning.
My pleasure to be here.
Well, Hayden, I want to come to you first. So what is private equity?
So private equity, and really private investments more broadly, is a lot of the same things that are invested in across normal portfolios, but in a structure that's different, basically not publicly traded stocks and publicly traded bonds. It's debt and equities in companies that are held in a private structure. And so it's a lot of the same things that people are already investing in defined contribution plans, but in a different structure that has some advantages and some challenges.
Okay.
And the thing that I would add, Jeff, is that these structures that Hayden alluded to allow for the investors to be much more active shareholders and to have a lot more influence on the management of the business, the incentives that are provided to management, and that provides some significant advantages over publicly traded securities.
So Tom, what are some of those advantages?
So private markets typically are referred to as patient capital. So you can engage in long-term transformation of businesses. That could either be turning around a troubled business or investing in a business that has high growth potential, but building that growth over a longer term. The other thing that it allows investors to do is to react to changing situations with more shareholder interest rather than management interest. So the crisis that we're going through is a great example where shareholders can make much more dramatic decisions about how to restructure businesses when necessary than management might do on their own.
Thanks, Tom. And I guess in terms of the sectors where you would find private equity, I know in my own personal experience, I hear a lot about healthcare, but are there segments of our economy where private equity is more heavily invested than others?
If you look at the sectors that private markets invest in, it looks a lot like the S&P 500 or the MSCI. So it's a range of different industries. One thing that I would say is you actually get more of different types of exposure to longer term assets. So real estate or infrastructure, for example, is a much more, those are sectors that are much easier to get exposure to through these structures that Hayden referred to than through the public markets.
Okay.
And I think one thing that's worth also adding is more and more companies are staying private longer. So more and more of the companies that are out there are really only accessible through private markets. The number of public companies is declining, the number of private companies is growing. So for investors that are really looking to get a broad exposure to the economy, having private exposure as well as public exposure can be important.
Well, thanks for that, Hayden. And when it all comes down to it, we're either talking about returns or we're talking about fees. So how do you balance the risk versus the reward when it comes to the return streams for private equity?
Right. So, there's some research that DeCalta has done with the IPC looking at what if we took a target date fund or a balanced portfolio and replaced some of the public equity with private equity. And in those scenarios, on average, you get better returns by adding private equity with the same or a little bit less risk measured by volatility. So if you're looking at just those risks, you sort of get a better outcome on both sides of the card. There are other risks such as liquidity and complexity that I think can be more challenging for defined contribution plans. But those are things that can be managed and can be tackled. And if you look at DB investors, foundations, endowments, family offices, they've been dealing with these types of investments for a long time, and has really resulted in better returns and better outcomes for them. So it's something I think can really help, improve outcomes for DC participants.
Well, Tom, I want to come to you because I think Hayden laid out a very important case. And when you look at endowments, foundations, and even pension plans, they have access to private markets. The only ones that do not currently are those within a defined contribution plan or a 401k type plan.
It certainly does. I think it adds a lot of stability to a traditional investment portfolio, as Hayden alluded to. But the challenges that he talked about are also ones that have to be closely monitored, particularly liquidity. I think it's important to understand what the liquidity profile of these assets is going to look like. I think in a tranquil market, a mature private equity portfolio will throw off about 8 to 10% of net cash flow per year if you're sustaining a consistent exposure. But you do see in the GFC, for example, there were about 2 years of negative cash flows from a mature private equity portfolio. So when you get into an extreme market, you need to be able to get through those periods of illiquidity, which unfortunately happen right when you need that liquidity the most. So we think it's quite important for any investor in private markets to think very carefully about what the limit of exposure to these illiquid assets is in the overall portfolio.
Well, Hayden, I want to come back to you, but because are there thresholds when you're looking at this? There are certainly thresholds in pension plans and endowments in terms of asset allocation, but are you thinking about, how are you thinking about it within a defined contribution plan? Are there thresholds there that you're thinking about as well?
Yeah, well, I mean, first of all, I think if you're going to put this into a DC plan, it has to be within a either target date fund or balanced fund or something like that. You don't want to give participants the ability to do it themselves because they aren't going to pay any attention to those caps you're talking about, Jeff. I would say you have to have enough. First of all, there actually might be a floor on exposure because if you don't have, if you have just a little bit, some of the liquidity and headaches that come with it just aren't worth it because you aren't going to get an impact.
Right.
I would say if you get much above 15%, 20% of private exposure, that's going to be too much. Because it also, you have to think about in a steady state, you might be at 15%, but you get a crisis that may balloon up because of the liquidity, that Tom was talking about. When that liquidity dries up, it might get bigger. So you want to make sure that you sort of have an idea where you are in a steady state, but also make sure you look at stress tests as well.
Well, Tom, when you think about due diligence, in the public markets, we have access to prospectus, we have access to third-party tools that allow for maybe more access to more readily available information. How does this compare when you're doing due diligence on a private market investment like private equity or some other alternative investment? How is that different?
I think it's not only information that's available, but it's also being able to understand that information in context. There's a lot of pattern recognition that comes from being engaged in the private markets on a regular basis. And that's why even very large institutions will hire somebody like Cambridge or Stepstone to help them understand the global private markets. I think the other important thing, and Hayden was talking a little bit about this, from a structural standpoint, a DC plan needs to have sufficient diversification, both from a market perspective, so a range of different types of strategies, as well as from a liquidity perspective, enough individual underlying assets that they can provide liquidity on a regular basis. And so by combining those assets across a fund rather than for individual buckets, you can provide that type of liquidity.
Well, Tom, as you know, fees are a big issue in the defined contribution space. We have a litany of fee litigation that's going on and has been going on for well over a decade. How do you balance that risk reward versus the fees? Because it's not as easy as just saying it's the lowest fee possible.
So when we look at the return profile of private markets, we're looking at it on a net basis. So net of the fees that are paid to ourselves and to the GPs. You need to make sure that the returns that you're getting are worth it on that net basis. Now, when we look at a mature portfolio, the net of fee or the fee drag on or fee intensity of a portfolio tends to be about 250 basis points over the long term. So it's not insubstantial, but it's not quite as dramatic as some might be led to believe.
Yeah, and I'm sorry, go ahead. Sorry, I interrupted you.
It's important to really understand what the real impact on returns is. And then secondly, I think the correlation of private markets assets is important to understand. So it's not just that private markets are delivering an extra couple hundred basis points of performance over similar types of public assets, but it's the lower correlation to those traditional portfolios that is driving your overall portfolio up and to the left on that risk return matrix. So making sure that you have the right mix of strategies that gives you that diversification benefit in addition to the alpha. Those are the two dimensions that you need to be aware of as you think about kind of the fee intensity and how expensive a private markets portfolio might be.
And Hayden, anything you want to add on fees before we go to a quick break?
Other than I think they are important, is as Tom said, the key is you have to look at net returns. And what really matters is the outcomes that participants get net of all the fees. And if those outcomes are better net of the fees, then it's worth it. And think about how much you're paying. The one thing to remember, fees are constant and the alpha you generate is not. So you're taking on some risk there. But all the analysis we've done, I know the analysis Tom does, we look at net of fees because if you look at returns before fees, you're just diluting yourself. So if you look at after fees and say, what am I getting for what I'm paying? And if you end up with a better outcome after you're paying for it, that's better for participants.
Yeah. Well, gentlemen, I'm going to hold you over, but when we come back, we're going to talk to Hayden and Tom about practical applications of the private markets in today's retirement plans. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
If you are like 58% of Americans, you didn't go to college. Or you did, but never finished. Maybe it's the thought of a big, intimidating campus. At Independence University, all classes are held online. Maybe it's the thought of being alone in a sea of students. At Independence U, you'll get a personal support team to help you every step of the way. Maybe it's the cost of all those books and supplies. Online means no books to buy. We even give you a new laptop and tablet to keep when you graduate. Maybe your life doesn't fit typical college classes. At Independence U, our online college fits your schedule. Let's meet a few students.
Independence University held my hand through the process.
Don't be afraid to take the leap because it has changed my life drastically.
Just take the first step and you can do it. If I did it, you can do it too.
At IU, there's no barriers to your degree.
800-535-9916.
Welcome back. We're talking to Hayden Gallery of Cambridge Associates and Tom Keck of the Stepstone Group. Gentlemen, thanks so much for staying with us this morning.
My pleasure.
Yeah, it's great to talk with you. So one of the things that I really appreciate the lessons on private equity, what that is. I think there's a lot of people out there who don't really understand what private markets are. I think we're just kind of scratching the surface on that, but I think it was a great start. The other thing I want to do is maybe tackle or dispel some of the myths that exist around private markets and private equity. And Hayden, I'll start with you first. I mean, what are some of the things when you're maybe meeting with a client or you're just talking with people out there who have an idea or think in their head what they have an idea about private markets, what are some of the top myths that come to mind?
I think the first myth that comes to mind is that it's super risky and it's a great way to lose a ton of money and you're just making, lottery type bets. And I think, you look at returns and you look at the historical data and, the returns are actually as consistent as you get in public markets and actually can be less volatile because you don't have some of the short-term trading nature that you get out of public securities. So some of that volatility that people see as risk in the public markets just isn't there in the private markets. And
Tom, how do you, why is this a myth? I mean, is it just, erroneous reporting or, people just are not educated? I mean, how do you bust this bubble, I guess?
I think it's your lack of information. I mean, we talked a little bit about that in the last segment, but if you think about what the value proposition of private markets is, it's active shareholding. And so when you look at the returns on an individual private asset, those returns have a beta component and they have an alpha component. Yeah. And the beta component is what it is. Sometimes that's accentuated by leverage. But the alpha component is actually a much more significant element of the return stream. And that's what sort of contributes to this ability for private markets to be more stable or less volatile. There is an element of, general partners are marking their assets to what they're willing to pay for them. So when markets go down, our research indicates that private markets go down about, the beta to public markets is about 0.5 in a down market. Mm-hmm. That beta rises to about 0.9 in an up market. So a lot of what contributes to this lack of correlation and this stability that Hayden was referring to is the fact that private markets are able to have more idiosyncratic risk, and therefore when you put a bunch of assets together, there's a lot more diversification that's happening, and this asymmetric beta profile relative to the public markets. And that's really what drives the outperformance in private markets.
So, Hayden, is it just, to echo what Tom said, is it really just education and, getting out there, informing people, informing fiduciaries? Clearly, people are using this. We're going to talk about practical applications in a minute. People are using these investments in endowments, foundations, pensions, right? That many plan participants and members are invested in, or at least going to draw a benefit from. So is it more and more about education and just trying to keep people abreast of what these instruments truly are?
Yeah, I think education is a key in taking, a lot of plan fiduciaries, particularly where they're more on the human resources side rather than on the finance side of the house of plan sponsors, and educating them on how they work, the nuts and bolts, walk them through the process, walk them through, the math that Tom just did of how much is market return, how much is alpha that you get from, the companies and what the private equity firms are doing. And really just explain it to them in basic terms, break it down to what it is. And then it's also looking at what the data that we have for, the last 30 or 40 years of the industry and what that means. And I think that's really the key, is it's an educational process. It's teaching people about what can be a relatively complex asset class, But you can explain it. The building blocks are relatively straightforward. It's something we should be able to explain to people.
And in terms of, I mean, there are lessons out there that you can draw from both here in the United States and also around the world, right? I mean, and I'll start with you, Hayden. I mean, there are other retirement systems around the world, and there are actually retirement systems here in the United States that are using this instrument, these private market instruments in their retirement portfolios, whether it's a pension or whether it also is a defined contribution plan.
Yeah, so if you look in the U.S., you've got DB plans, whether they're public DB plans, corporate DB plans. A lot of those have significant exposure to private equity, private investments, other alternative strategies. And even if you extend it into DC plans, you look at Australia, for example, where a large portion of the superannuation funds have exposure to private equity, private infrastructure, private real estate. And that is through a similar participant directed daily structure that they've been managed to implement it, and do so actually in a pretty fee constrained way as well. They've got a lot of fee constraints down in Australia as well. So that's there's other people that are doing it in DC plans, and a lot of plan sponsors on the DB side are already familiar with these because they're doing it in their DB plans.
And Tom, I would imagine that you, along with Hayden, are working with clients who are, both here in the U.S. and abroad, who are using these in their DC construct, or at least considering them as instruments.
Absolutely. So as Hayden mentioned, the Australians have been addressing the daily valuation issues for a number of years. We're working actively with a number of Mexican Afores or DC plans, which have a similar structure to the Australian superannuation structure. They are just, the regulatory regime there has just allowed them to start investing in global private markets. So they're really building their programs from scratch. And I think being very thoughtful in how they structure but how they're going to address the liquidity profile, because the regulatory structure there imposes some liquidity challenges that we're helping them work through. Similarly, here in the U.S., we're talking with a number of target date funds and DC structures on ways to provide liquidity either at the individual plan level or individual investor level, as well as kind of valuation support. So I'd say the tools in those areas are getting much more sophisticated and are really enabling a broader swath of investors to get into private markets.
Yeah, and the last thing I'll say is, I mean, the Securities and Exchange Commission, I think, recently announced that it was revisiting the definition of an accredited investor. And I think, I want to get your thoughts on this as it relates to our conversation, because this would seem to signify that changing those terms, what that definition is, would in a way validate that, hey, you've got to be able to, as an individual investor, be able to diversify even further and have access to markets maybe you did not, of course, doing it in a very cautious manner. Hayden, do you want to take that?
I think that sort of is an indication that there are benefits to this asset class. I think it's really important to keep people from running with scissors, as I like to say, and do it in a way that's risk controlled, where they're able to get the information Tom was talking about earlier. That there's it's not as easy as just pulling up a mutual fund fact sheet or looking at a prospectus. So there are things, making sure that it's available to everybody, and really democratizes investments so that the whole country can take advantage of this. But at the same time, making sure that we don't keep almost safe plan participants from themselves. There's a lot of risk of people really making bad decisions if it's not set up in a way that encourages good decision making. Yeah,
Tom, I love that analogy of running with scissors. You don't want to do that. You didn't want to do that as a kid, probably not as an investor. How do you all see it?
No, I think the democratization of private markets is certainly a major goal of our organization. But Hayden's exactly right. And the Australians, I think, dealt with some of this issue. It's not only the challenges that individual investors can get into from lack of information, but it's also the ability of unscrupulous sponsors to kind of take advantage and kind of put people into the most fee-intensive parts of the market. So there were some indiscretions in the Australian market that were addressed. Mexico's got a big focus on fees, and I know here in the States that making sure that it's not a situation where intermediaries take advantage of institutional investors, but actually through that intermediation mitigate some of these risks that we've been talking about and enable people to have access to these types of investments that institutional investors have been benefiting from for years.
Well, I think it's certainly worth educating yourself as fiduciaries, as decision makers. Hayden, Tom, I want to thank you so much for joining us on the program this morning. Amazing conversation, great lessons, and we look forward to having you back on the program again very soon.
Thanks, Jeff.
And that wraps up this episode of BRN AM. Have a topic of interest or someone you think we should talk to? Then drop us a line. And don't forget, for all the news in retirement, markets, technology, personal finance, and more, check out today's edition of our newsletter, The Morning Pulse. So until tomorrow, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.